Well, good afternoon, everyone, and thank you for joining us today. My name is Paula McCain. I'm a recovery business advisor for the North Central Texas Small Business Development Center. We are the leading provider of assistance for small businesses. I'm not sure if you knew, but today is National Pulled Pork and National Gumbo Day. So it sounds like dinner. The SBDC is grant funded, and because we are grant funded, we are able to provide webinars such as this and other resources to you at no cost. Today's presentation is Bankable to Bankruptcy. How much debt is too much? I'm anxious to hear this myself. Brought to us today by Rebecca Schultz. Please put your questions in the chat room and we'll get those answered at the end. A little bit about Rebecca. She's been helping business owners access money and financial education for over 25 years. She is the founder and executive loan consultant for Centerlock Funding. As always, Rebecca, welcome and thank you for joining us.
Thank you guys. I have so much fun, and this is a good topic. I really do like it, and I think it's really relevant for where a lot of small businesses are in the current economic climate, right? There's a lot of money out there. A lot of individuals are getting more idle disaster funding, additional funds, and there's some repayment obligations that are looming in the near future. And so as everybody's trying to understand maybe reduced cash flow or uncertain cash flow, and then that repayment obligation, right? That's the conversation that we're exploring today. So hold on one moment and I'll bring up the presentation. Okay. All right, here we are. So talking about being bankable to bankruptcy and understanding how much debt is too much. My name is Rebecca Schultz. I am the founder and executive loan consultant for Centerlock. And I do have over 25 years worth of lending experience, and that seems far off, right? But just know that I am very passionate about access to capital and trying to understand how to use, to our best of our ability, our existing resources, right? That's my passion. And I do love also quotes. So this is a good one for the conversation today. Money is only a tool. It will take you wherever you wish, but it will not replace you as the driver. Right, so in this quote, remember, it's easy to get off guard and get emotional about finance and money. It's just all too human. But at the end of the day, money is man-made, right? It is literally a tool. And we use that tool to our benefit. But at the end of the day, we are the driver, right? We're the ones that are using the tool. And so we always want to make sure that, again, we are in that control seat and we're looking at how we're using tools and resources to the best of our ability. So we're going to explore money as a tool today. So our agenda is going to take us into a few different directions. First, we're going to start to understand financial health. Right now, I put there financial statements. We are all coming at this conversation at different points, right? Different understanding of financial well-being, maybe different financial well-beings ourselves within our business. And so I need to put everybody on the same playing field or at the same level, kind of talk the same language. So we're going to spend some time kind of bridging that understanding of financial statements and how one looks at them in order to gain an understanding where they are, right? Where they are positioned in this conversation. So we'll do that together. And then we're going to start really getting to the crust of it. How do you define debt leverage? How do you understand how much is too much debt? Right? So we'll go through the definition of debt leverage. I'll introduce you to a couple concepts, what is considered good debt? Because believe it or not, there is good debt out there, right? There are times when borrowing is important and actually a wise decision. And just as the polar opposite is true, there are times where borrowing money can be bad, right? So we're going to explore good debt versus bad debt. And then after we have that exploration, we're going to take a step back and then we're going to talk about different tips for borrowing. I do have specific tips. At the end of the day, you're the driver, right? The business owner's the driver. And so understanding how to drive, now that you have your financial statement, you have a good understanding what good debt and bad debt is and where you might be positioning yourself, we're going to really understand getting access to quality credit or quality debt. Now, I'd be remiss if I didn't share with you some important numbers or ways to look or frame numbers. I call that key ratios, so that you can always know where you are in the optimum level of operation for your business, right? The healthy zone. And that what is unhealthy look like, right? I want to set you up for success. We'll take some time so you'll be able to measure your business not only today, right, but also in the future, so you can carry it on and know how much is too much, or when do you have availability to borrow more money, right? And then we're going to always end on important details to remember. We're going to come up with a good summary of the information so we walk away connecting all those pieces. Okay, sound like fun? All right, let's jump in. All right, so understanding financial health, right? Really getting to the bottom of it by financial statement analysis. Now, if you hear that and you're like, I'm gonna roll my eyes, I'm gonna catch a little nap right now, right? Rebecca will wake me up in a minute. Please don't feel that way. I know when anybody says financial statements, I think half the crowd checks out, right? But you don't have to be that way. To be honest with you, understanding financial statements can be exciting. It can be as good as reading a page-turning novel or like watching a really good Netflix series. We were just talking about that. Right. It is really a story, and understanding what your financial statements are telling about your business, right? What that story is and how you're understanding the future of that story, how you're positioning yourself for growth is really powerful. Right. And so I'm going to try to share my love of financial statements with you. Right. And so what we're going to talk about is three particular financial statements. Um, these are the standard three, right? But just understand there's more than just these three statements. There's a whole plethora of statements out there. You can create statements for anything you want to track or measure, right? But from an investment standpoint, three statements are typically used in tandem, right, all together to understand the health of a business. And we're going to focus on that. We're going to talk about the balance sheet, the profit and loss statement, also known as the income statement. So in your accounting, uh, I guess, software, wherever you pull your statements from, it may say profit and loss or it may say income statement. They're the same thing. Don't get confused. All right, and then of course your cash flow statement. All right, so the whole goal is to get those financial statements side by side. All right, and what you're going to do is you're going to do a review. You're going to understand or answer the specific questions. How is your company growing? Right? In a minute, I'll explore how you kind of see these little connecting pieces, but you want to understand how that company is growing. Are you going through actual operating revenue, how much money the business is making? You're keeping it and you're able to grow from operation income? Or are you growing from debt? Right now, the concern is a lot of businesses have lost revenue. They've replaced it with disaster assistance, and they're not closely monitoring the revenue increase and the expenses to a point of financial health, right? That's where we start to get into the bankable to bankruptcy conversation, right? So we want to see how we're growing. We want to understand changes in the revenue or expenses, right? So is the revenue increasing? Is it decreasing? Are expenses decreasing or increasing, right? We could hopefully track those or see some type of comparison from that side-by-side review. And then, of course, what are the changes in the liabilities? Right now, I'll tell you right now, I a few weeks ago went through 70 different financial statements for 70 different businesses. I know that sounds frightening, right? And when I was looking at all those businesses, I saw the increase in liabilities. It was just plain as day. Almost every single business in that review had an increase in liabilities, right? So you want to look at historically, what does that look like for your business and what's that story attached to the increase of liabilities? right? And are there changes in what we call retained earnings? Retained earnings, owner's equity, right? That's a term that we use for how a business has managed the growth over the whole life of this business. Right, we'll talk more about that in the balance sheet, which is coming next. But really, understanding the health of your business comes down to looking at that retained earnings, right? How well you've managed the resources and the income or the money that's left over, right, from operation income versus expenses, that becomes a retained earning conversation. All right, so let's move straight into that balance sheet. Balance sheet is my favorite financial statement, and it's one that a lot of small business owners just overlook. They gloss over it. And I think it's because they don't really understand the power of that balance sheet and the magnitude of the information that's available. I'll tell you a funny story. Right, I was working with some business owners doing some financial training. This is about a year ago. It was right when the pandemic was hitting. And a business owner from North Carolina reached out to me, and he gave me this line. He said, Rebecca, I'm looking at buying a business, and they gave me their financial statements, but I really only have the balance sheet. Would you mind taking a look at it and tell me what you think? Now, with that statement, I thought he was looking to acquire a business, and I was going to give him the, kind of skinny on what I could pull out of this one financial statement. Right. And in that conversation, I was able to tell him, the business wasn't operating with enough income, that they had taken on excessive debt, that it looked like they had ramped up employees and offloaded employees, that the business owner was taking too much money out of the company, and then he was leveraging the debt to offset how much money he was taking out. He wasn't committed to the company. You could tell in the retained earnings. By the end of the conversation, he was speechless. And he said, Rebecca, to be honest with you, completely transparent, this was my business. And he said, I didn't think the balance sheet was very valuable. But I honestly don't know how you got all of that out of that one balance sheet. But you were 100% correct. That's exactly my experience. And he's like, I'm floored that all that information is available in that one financial statement. And it's true, right? So if you underestimate the value of this financial statement, I promise you it's there and you can read it like a book if you put a little energy into it. All right. So the whole premise of the balance sheet is to understand the business's assets. And there's a little equation we follow. Assets equal liabilities plus owner's equity or retained earnings. All right. So think about it this way. The assets, cash, inventory, fixed assets, right? Maybe accounts receivable if you're more of a service business, assets. Right, that's what makes up a business. Now that's going to be equal to any debt that it owes, plus any wealth it's created. That's retained earnings, right? Money that it's created, profitability over time. So profitability over time minus debt, which is, kind of like a stake against that. You've leveraged the business to get access to capital, right? That should be equal to assets. Hopefully everybody kind of sees that and they're like, that makes sense. Okay, because we're going to start breaking it down. This balance sheet is going to measure the performance of that business entity from the very beginning, from when it started. Now, if we were talking about a business that's been in operations over 100 years, that one balance sheet is going to tell us how that business is done in 100 years. Right? This is like mind-boggling, right? But unlike the profit and loss or income statement or a cash flow statement, which is just for a period of time, you're measuring activity in a time. Balance sheet is as of a certain date, and it goes all the way back from the very beginning, right? And you look at how leaders within that organization have leveraged their assets in order to generate income, right? That's the retained earnings. So they've leveraged their cash, inventory, equipment to generate money, right? And hopefully grow a company in a profitable manner where there's more retained earnings or owner's equity, right? And then they take those retained earnings or owner's equity and they invest it, right? This is return on investment. And they generate more assets, right? They're growing a business. For every dollar they invest, hopefully they generate more than a dollar. in some type of profitability and the business grows. That's the essential point of having a business, is being able to see how they're reinvesting those assets. And all of that comes through on a balance sheet, right? So at the same time that we're looking at the asset growth, we're also looking at the liabilities, right? That's the measure of outside investment. That's the bankruptcy conversation, right? If they're taking too much outside investment to grow their business, okay, and I'm just going to interchange some buzzwords here, some government debt like idle loans, right? Money from the PPP, and that might be okay, right? You paid that out in payroll, but essentially taking other money, other investment, and they're using that to grow the business. If they're taking too much from the outside and there's not enough money coming from inside the business to offset that, right? We're growing from liabilities. We're increasing our overall liabilities in respect to our assets. Now, I'm just going to state the obvious here. If you had to, shut up shop, right, close the business, and you were taking a look at your balance sheet, the goal for that business owner is to at least have more assets, more cash, accounts receivable, inventory, more good stuff than liabilities that they owe somebody else. So if you're looking at assets versus liabilities, hopefully you have more assets than liabilities. If you don't, right, that current asset to current liability ratio is off, meaning you have more liabilities than assets, then we're in trouble, right? We call that insolvent. That's where you get to the bankruptcy conversation. A business can't operate for very long when they have too much debt. Okay? Right. And then finally, understanding really that owner's equity or the retained earnings conversation, and that comes at the bottom of a balance sheet. In just a minute, I'm going to give you a visual, all right? I'm going to give you a visual because I know I'm having you hold all of this in your mind's eye. But you'll see at the end, if we look at that retained earnings or owner's equity, it really tells us how the managers of that business are either reinvesting and growing more value, right? More wealth for that business, or they're losing money, right? And they're not retaining it and then weakening the position of the business, right? That everything happens in that retained earnings conversation. So hopefully that gave you some new information on the balance sheet. I know this is very squishy. I'm gonna just kind of blow this up for you real quick. Here you go. So when I say do a side-by-side review, right, I want you to take different periods of time. In this case, we look at 3 years side by side. That's a pretty normal bank/investor conversation. If you don't have 3 years, do not panic. You take what you have, right? And the more years you have behind you, the more insight you can pull out from having that comparison. But just like we talked about before, you've got your assets conversation. So here's our assets, right? We got our cash, accounts receivable, everything from fixed assets like land and building, right? Depreciation's in there, and then you get to the total assets. All right, so from the first year, this is 2014, next year's 15, 16, and a projected 2017. All right, you can kind of see how those assets right down here have managed. So they had in 2015, 653,000. And they increased in 2015 to 736. Would you say that that's a good job of management? I would say, yeah, right? They increased assets. The goal is to increase the assets. Hopefully that means more cash, right? But something right's going on in that business, right? And then down here in 2016, you see how they dropped a little bit. There's a story there. So that's where you start to try to understand, why did your assets drop, right? Was there more expenses? You start to ask questions. All right, now finishing it up, just giving you that overall review. Then you take the liabilities, right? Remember our equation, assets equal liabilities plus owner's equity or retained earnings. So we look at our liabilities. So here they are, right down here. And you can see what's happening. We want to look for those trends, right? They were at 838,000 and they dropped down to 830. So how's that trending? It's trending down. So that's good, right? That means that as we're increasing assets, we're paying down some of the liabilities with those increased assets. I think all of us could say that that's a good management, trend. And then you can see where it even decreased even more in 2000 and what was that, 16? 2016, even though the assets were not as high. So they are committed to paying down debt. But check it out, they're projecting taking on more debt in 2017. They're looking to borrow more money, all right, making more investments. They're taking outside investment to grow their business. All right. So then, remember I told you it all comes down to that retained earnings or that owner equity conversation. Well, here you go. Total equity. Now, we have negative equity here, okay? And I don't want you to panic. That's normal for small businesses, all right? It takes a lot of energy and a lot of investment in order for business to grow. And a lot of times early on, they don't have a lot of profit because they're constantly reinvesting into the business and of course trying to pay for the owners. So do not be alarmed if you see that. What you want to look for is trends, right? So they had $185,000 in the hole, okay, over here initially in 2014. They got down to just $93,000 in the hole. I would say that's successful, right? That means they improved over $90,000. There's some profit in there. And then they got a little less negative. And check it out, they're projecting being super positive, right? That's overly optimistic, it looks like. But again, you're starting to see trends where you can start to read the numbers and try to understand how the management is operating for the entire health of the business. All right, so there's a lot of information. I want to go into more detail on that particular financial statement because I think a lot of people don't use it and they don't realize the power of the story that's connected to it. All right, so hopefully that was helpful. All right, moving on. Remember, there's three financial statements. So the next one is going to be the profit and loss statement, also known as the income statement. And if I were to wager which financial statement small business owners use more often, it's going to be this statement. So when you see it, it's going to be very familiar to you. Okay? Remember, this is a measure of time. So unlike the balance sheet where it measures all of the business health up to a point in time, this is typically going to be between two endpoints. For instance, January 1st of 2000, blah, blah, right, to December 31st of 2000, blah, blah. Typically a month or a year or a quarter is how people look at these statements, right? Okay, so this particular statement is just going to be a measure of financial performance over a period of time. So for that year, that month, that quarter, whatever you're measuring, it's going to be that bookend of how the company has performed. Right? It's going to help you review how much revenue the company has generated during that little period of time. Remember, it's not overall over the entire life of the business, over that period of time. And then it's going to do a relationship between that revenue and the expenses associated with generating that revenue. Right? So you're going to see your revenue, you're going to see your expenses, and what's left over typically at the bottom line is what we call net income or profit. Right? Now, I heard this story, and it's so true, about a business owner about 100 years ago, right? And he said that his whole goal in operating his business was to generate more money at the end of the day than they started with, right? They knew that they did a good days of work when they took that dollar and they came home with more than a dollar. Okay, and so that premise is exactly what we see on that profit and loss statement or income statement. We're looking at that net income, seeing how much money we've generated over that period of time. Okay, so easy to understand. Now let's just go ahead and connect that knowledge with that side-by-side review. Again, looking at the same business. All right, in this we see there's the sales or revenue. This was actually an agricultural business. They raised turtles. I know you don't think about turtles being a commodity, but apparently they are. They're a hot commodity. All right. And there's some cost of goods sold associated to raising those little turtles. Right. So you've got the cost of goods and then you've got your gross profit. So you got your sales minus your cost of good, gross profit. And then you've got all the expense associated with it. And so there you go. There's the income, that net income. So if we were to follow these trends for that same period of time, you can see that, what was it, 2014 was a loss. They lost 22,000 that year. right? And then in 2015, they made a profit, 91,000. And then in 2016, they made an even bigger profit, and they're projecting to make an even larger profit, right? So again, we're looking at those trends and we're trying to understand the health of the business. And so far, it looks like they're on a pretty good trend, right? And they're projecting an even better trend. That gives you just that little kind of confidence in understanding that income statement or profit and loss statement. Okay, so we're all on the same page, right? We're merging our data, we're merging our knowledge. So when we start playing more with these concepts, everybody's on the same page. All right, so let's go into the third and final financial statement we'll review, and that's what we call the cash flow statement. Now, the cash flow statement, that is unique, all right? And I wish more business owners use the cash flow statement because they would see a lot more than just looking at the profit and loss or income statement, right? So when I say they would see a lot more, a cash flow statement measures not only how much income or cash, physical cash is coming through the door of that business, but how they've used it in their operations, right? Really short and sweet. It tells you how much cash was generated, tells you how much cash was borrowed. So if they're seeking outside investment, or maybe they're getting shares, like they're selling off percentages of the business and they're generating from that stock or liquidation of shares, right? And then we can see what they've done with it. Are they reinvesting R&D in the business, right? Are they going to just general expenses? Those big shifts on that operation, you'll be able to see that money usage. And then it does something unique. It gives you the beginning cash position at that period of time, right? And what the ending cash position was. And it helps you somewhat understand the mindset of the business owner and what they were forecasting and what they've done with the money that they've taken in the doors, right? Okay, so if you have a cash-based business, let's say a restaurant, right, and you're thinking maybe my profit and loss statement or income statement is going to be wildly different from my cash flow statement, you may see something very similar. But if you have what we would call a business on accrual basis, for instance, you invoice clients for services or goods and you wait for a period of time to collect your money, right? That's where you're waiting in time. Then your cash flow statement would be wildly different from a cash base if you're accrual, right? And so for those accrual base where they're invoicing and waiting periods of time, I highly encourage you to pull that cash flow statement. It will typically tell you a completely different story. All right, so let's zoom in and let's see what we're talking about here. So here's a cash flow statement, right? Same periods of time, same business. So we can see how much those net sales were, right? How much money they actually brought in the door these years, right? So cash from sales, and then of course any change in payables, right? How they're paying their vendors or suppliers. So you can see there's some change there, right? How much of their gross profit is, and then you can start to see what they're doing with their money, right? Are they paying interest expense, maybe dividends to shareholders? Not really, right? Are they making investments in the business? Looks like there's some investment. Capital expenditures, definitely you see a little bit of that, right? Are they reducing their outstanding debt? You can see that, right? And at the end of the day, we're seeing what kind of change in cash on hand there is from the beginning to the end. Right? Pretty eye-opening. All right. So now we got an understanding of all three financial statements. We've seen it. We understand the power of looking at the different periods of time to connect it to the story. Now you're ready to go ahead and start really defining what debt leverage is. Okay, so debt leverage, right, having a lot of debt, okay, is really looking at what we call the big picture. It's really trying to understand how much investment dollars you've taken to really grow that business and to grow the business assets. Because remember, just like that 100-year-old saying, right, at the end of the day, good business has more money at the end of the day than they started with. And so by really understanding debt leverage, you're understanding whether that money is coming from outside investment debt or it's coming from internally with the business growing itself. Right, so there's different types of investment. There's bank debt, right? So if you work with your bank, your local community lender, that's one form of debt. And a lot of people will say that's one of the smartest ways to do business or to borrow. And when I say smart, right, that's objective. It's just typically going to be a less costly method of borrowing. But there's other forms of debt leverage. There's equity investment. So you see on Shark Tank, right, where people will come in as silent or private investors and they'll give money to the business, but in replacement of that money, they're taking shares or stock in that business, right? That's going to be your equity conversation. So they're taking equity, they're banking on that business growing, and then some type of exit strategy, right? There's owner investment. That's typically how businesses get started. The owner invests their own money into that business to get it going. And certainly as an investor, you want to understand how much you've contributed and hopefully one day take your money back out, right? Plus whatever value you've created. That's part of that retained earning conversation. Right, and then we've got private investment. Now, private investment can look all different kinds of ways. Right, I don't want you coming in thinking that it's one thing. Private investment could start off as equity and then what they call convertible, then turn into debt that gets repaid back. Private investment can be at 0% interest for 30 years, or it could be, at 12% interest, 20% interest for 1 year. It just depends on what you've negotiated with that investor. So there's different types of investment that businesses can pull from, right? Now, one thing that's alike no matter what type of investor is that investor seeking some type of return, right? They are looking at a return on their investment. And so there's usually a give and take conversation. They're going to give, right? But at the end of the day, there's got to be a take. There's got to be something coming back to that investor that makes it worthwhile for them to support you, right? To go into business with you. All right, so the type of investment dictates the structure and the repayment terms of that investor. Right? And remember, that can be different. There's all different types of conversations here. All right, now we understand the big side of what we're talking about with debt leverage. Let's start trying to define what is good and what is bad. Right, so good debt is typically investment money that is borrowed under reasonable terms. Now, when I say reasonable terms, let's define that, right? Because you might think it's completely reasonable to pay 50% of your money back in 1 year. You might, right? You might come from another country and nobody gives you money, right? And they might want 100% return back. We don't know where other people have been, right? So I want to make sure we're all under the understanding of what is considered reasonable. And so I'm going to redefine it for you. It's really money that's borrowed that allows for the borrower, in this case, that's the business, to repay the debt and still survive. Okay, that sounds great, right? That makes sense. So there's not going to be a threshold. I'm not going to say a certain rate, right? We just have to understand that that money's going into that investment vehicle, that business, and hopefully going to start generating more assets than it started with. So if we can understand the cost associated with borrowing that money and then the opportunity, right, the money that's being created from it, that specific information will help us understand if borrowing that money is good or if it's bad. Right? The whole goal is for that business to increase its business assets, right? And to increase a return that repays back those investors. That's a lot of information, but I want to just have that sit with you for a minute, right? You want to make sure that how you're using that money that you're borrowing in the business generates an increase in the assets and takes into consideration having to repay back that investor. And again, it can look in all different kinds of ways, right? Just make sure that there's a clear understanding of how that investment will be used to make money for you to be able to understand if it's a good debt. Okay, I know You wanted easy answers and I didn't give them to you. I'm sorry. Okay, so what is bad debt, right? So on the opposite end, what is considered bad debt? So in this case, I'm going to say it's investment money. Remember all different kinds of investment money, but it's investment money that's borrowed under poor repayment terms. And when I define poor, that's money that the company will not be able to generate to repay back the amount it borrowed. Like it cannot generate enough money to repay back the terms that have been placed on it. Now I'm going to slow down here and I'm going to talk about a growing trend in commercial financing that has gotten to be very dangerous. All right, and I'll connect a realistic story to it so you'll be able to see what I'm seeing here. There's what we call merchant lenders. Right? You might have heard that term, or you might know it as maybe credit card loans, right? Merchant lenders. And what they do is they make it really easy for small business owners, especially if they take credit cards as a payment, to be able to borrow money. Like you can go and get money, and typically within 48 hours, you'll have a deposit from a loan in your bank account. Now, what they do, and I'm not slamming anybody here, but what they do is they understand really well how you collect money in the form of credit cards, and they know what you're going to anticipate getting on deposit within a few days if that deposit is showing up in your bank account. And so a lot of times these merchant lenders will craft loan agreement, like structure repayment terms on a percentage of how much you anticipate collecting in credit cards. Now, how is that dangerous to a business owner? Well, if you don't know how much money is being sucked out of your bank account, right, and you're trying to make payroll and trying to run a business, that uncertainty of having to guess or try to ascertain how much is going to be deposited on a given day can be very crippling to businesses. I've seen them go under. Right now, I'll connect that conversation to a real life example. I had a salon that was suffering from a disaster, and they had taken out a merchant loan as a last resort. Now, they knew that the disaster was temporary, right? And their whole goal was to be able to repay back that loan as soon as they got government disaster money. Government disaster money was going to come in, was going to pay off the merchant service loan within a short period of time, and they would just be able to kind of get the jump on keeping the business's doors open. Makes sense, right? That was the leadership conversation. They never got the disaster money. Didn't happen, right? They were stuck with the merchant loan. Now, the repayment terms for that merchant loan were such that the business owner couldn't make payroll, right? And then it happened to be right before the week before Christmas, right? They had taken out the merchant payment and the business owner couldn't make the payroll the week before Christmas. The employees had an uproar, right? And they all left, and the business literally had to fold because it didn't have employees. They were reported for not paying payroll. It was a disaster. That would not have happened if the business owner didn't have one of those merchant loans. Okay, so if we're trying to define good debt to bad debt, hopefully that example illustrates where not being able to borrow money under the right terms, regardless of the cost, right, can cripple that business and become bad debt. All right. I also want you to take a step back, and when you're thinking about good or bad debt, understand what you're using the money for. Okay, I like this term called plugging holes. Right? When I was a junior loan officer, that term was used. And really, we tried to understand, is this business owner going to take this money, this asset, put it in the business to generate more assets, or is the money going into the business and basically just plugging holes like a band-aid over a wound? It's not actually going to generate money. It's just going to keep it operating. It's going to help it survive, right? You never want to borrow money to plug holes. That means that there's an operational issue that needs to be managed or handled, right? And it's not necessarily a good investment for an investor or for the business owner to be borrowing money, taking outside investment to just minimize problems or reduce the burn, okay? Money cannot generate a return. So if you're borrowing this money and you're uncertain of how you're going to pay it back and you don't see the cash flow trends in the right direction showing that you'll have money sufficient funds to repay it back and continue operating, slow down, right? That is not a good investment. That could be signs of bad debt, right? And I always want business owners to understand, right? Like a bad debt, you really understand it when there's no clear path to how the company will be able to grow and to repay back the investment. If you don't know how you're going to survive next month, right, or pay that next payroll, or be able to get that next client, if you're uncertain of that future, you don't necessarily want to put yourself in a position of taking other people's money to try to figure it out, right? That's a desperate move. Right? I call that the hair on fire moment. You don't want to run to investors with your hair on fire, asking for them to put it out. It makes for a bad investment and it makes it difficult for you. Okay, so we're going to take a deep breath, right? We just came through that. Right? Hopefully that helps you frame the conversation, right? What does that all look like? How's it all connecting? Because now we're going to go into the tips before you borrow, right? Really understanding what would make a good investment money and when it's okay to continue borrowing, right? Or if you're in good financial health, you can be bankable. All right, so make sure before you borrow that you have a good understanding of what you need and why you need it. Right now, I sit in those conversations every day with businesses seeking capital, and sometimes the vision's in their head and it's not in an oral or written communication style that makes it easy for the investor to understand. So here's some tips, like answer these questions and prepare them. This will help you with being able to be prepared. Why are the funds being borrowed? Why do you need the money? It seems so simple, right? But it gets so complicated. Like, are you growing with money? Articulate the growth. You're going to take that money, you're going to invest it. How? And since you invest it, how much money are you going to create from it, right? And from that creation of capital, how are you going to repay back that investor? Right? You always got to think about them, right? And if it's not for growth, are you trying to plug holes, right? How many holes are there? How deep are these holes, right? How big and broad? Because you need to define that for yourself and for the investors. Okay, and then next question seems so simple, but it's so true. How much money is really needed? You have to be articulate. And by the way, this is the number one reason why businesses fail is they don't understand how much they really need. Right? There's got to be like some idea of a forecast. There has to be a running total of how those expenses are going to go. You need to be very clear on what you're trying to achieve here. And then, of course, um, detail how you're going to use that money in your business. Are you going to buy equipment? Are you going to buy inventory? Are you going to hire people? Are you going to market? How much are you going to spend on all those or any one of those? Right? Make sure you have a detailed understanding of how that money is going to be used. The investor wants to know the plan. Okay. And finally, when you get through that, right? How are the cash assets being converted? Okay, I call this that clear and simple path to getting repaid, right? That comes into the cash flow statement. So, how much money are you anticipating making? And is that cash sufficient to repay back the loans or investments? Show it. Be certain of it before you take other people's money, right? Um, can that cash be spent or buy equipment or assets to generate more money? How is it converting from the sales or the transaction into cash at the end of the day, right? And is that a cash-based conversation, like we talked about, or is that an accounts receivable, right, or an accrual base where it's borrowed on time? I think about that. You've got to think about how that money is actually going to flow through that door in that cash flow, right? And then I like to throw this at you because by the time you're thinking about all of this, big warning, right? Lenders, investors are going to be looking for a secondary form of repayment, and that's what we call collateral typically, right? And are they going to be leveraging lien or taking collateral to help ensure that you pay back that loan? All right, so why is that an important conversation? All right, so remember that bankruptcy part of the title? Right? Okay, so if we're not paying back our investors and it goes to court in any manner, shape, or form, typically when there's collateral involved, which in most cases there are, to be honest, right? That means that you could be staking the entire business on repaying that investor, right? And remember that story about that salon that was in disaster and couldn't pay their employees the week before Christmas? Well, I'm going to give you another little tidbit. That merchant lender that they were tangoing with, right? They had a lien and they ended up freezing all bank accounts, right? The business owner lost every single penny that was in that business account. It was shipped off to this merchant lender, right? They had nothing at the end of the day. And by the way, in that lawsuit, they came and attached themselves to all the equipment, furnitures, and fixtures to offset to repay the loan. They literally had nothing by the end of that conversation. So be very mindful of that collateral leverage conversation, right? I know, does this scare you enough? I know, probably, right? I know. Okay, so I mentioned earlier that when you go into one of these investor relationships, there's a give and take, right? That investor is giving you money, right? As much as that makes us happy, right? They're expecting something in return, right? So let's talk about the give and take. All right, investment relationship is a give and take. It doesn't matter which one of those investment that you're looking at, the bank, the private investor, the equity investor, right? There's always a give and take. So the investor, from their standpoint, right, there should be some benefit to working with you, right? They hopefully are giving some fair terms, enough capital to support you, right? One of the worst mistakes a business owner can make is going in with an investor and not getting enough money and thinking they can bootstrap it without the full amount of money and realizing that they've locked up all their assets, they've locked up and tied their horse to, something that's not going to fully support them in the manner they need, right? Is it enough capital to support you? Um, is the advisor that you're working with, is that person or company that you're working with going to continue to work with you in an ongoing capacity? So let's say you start to grow better than what you thought and you need more capital. It's a good capital, right? It's a good type of thing. Do they have enough money to continue your support? I ran into an investor the other day that had a private investor that backed them and they ran out of money, right? Just as they were about to close a huge deal. And then they had already leveraged all their assets and there was nothing there for any other investor. And that other investor couldn't support them and it essentially crippled the company. I honestly don't know if they made it. All right, next, networking, right? So investors have their own network. This is clear when you do watch shows like Shark Tank, right? Or you watch any type of those investment shows. They always talk about introducing you to key partners or having experience that can set you up for success or open the doors for you, right? So when you're considering investors, you typically want to consider investors that have knowledge of your industry, has some type of resource path for you, and can contribute in ongoing advice, knowledge, support that goes beyond the monetary. Okay. All right. Now, what do these investors want, right? They typically want something equal to what they perceive the risk being. Now, when I say perceive, right, I'm going to make sure people understand that investors, they're not you. They don't see the vision the same way you see it. You have to work really hard so that they can clearly understand what you're seeing, right? And you really want to maybe speak to the risk that they think is involved in them getting their money back, right? And as much as you can mitigate that risk, as much as you can make them feel comfortable and confident that it's a sure thing that they're going to get their money back, plus what they anticipate wanting to make on it, then you know that you've got the right type of scenario, right? You have control in that dialogue. You're the driver when you talk about reducing risk and making them feel comfortable. All right. So remember, what you pay is typically going to be equal to what they perceive this risk being, and you're the driver in that conversation. Right. And they want a positive relationship, right? They don't want to dread having to pick up the phone and talk to you. You want it to be a relationship where they really are excited to be able to pick up that phone, talk to you, visit you, that they welcome this interaction, right? And they're looking for that too. And they're wanting to make additional investments in opportunities where they like the people they work with, right? So this gives you the opportunity to maybe expand, be a serial entrepreneur if you've got the right relationship. So they're banking on that, right? They also want to make sure that they take on clients that help them be better. Now, when I say that, I'm going to slow down. Like, think about just a regular average relationship. Two friends. One, you get nothing from that. They're the mooch, right? They're the one that you were constantly having to buy coffee for, and you get nothing out of them, right? You just feel like they're a drain on you, right? And then there's like the other friend who's constantly outgoing, sharing, connecting you to new clients, customers, always positive. Who are you going to gravitate to, right? Right? They're looking for ways to grow themselves, grow their network, right? Grow in knowledge and experience and resource. They're going to be looking for people that are positive, motivating, and have that type of ability to challenge them and to show them new ways. All right, so think about this whole give and take on a much bigger level. What are you needing? Right? What should you consider? And what is that potential investor looking at you as a kind of expected benefit? All right. So hopefully that has challenged you a little bit. Because we're going to talk about choosing your relationship. Which one is right for you? Right? There's so many different out there. I want you to understand there are different investors and there's different types of relationships. So know in your mind what's going to be a good fit for you and then use that good fit model to set up communication. All right. So if you're looking for a bank or traditional lender, just know they're more hands off, right? They don't want to know how you make the cookies. They just want to eat the cookies. Okay. They don't care. They're not sitting there micromanaging how many, chocolate chips go in the batter. They just don't care. They're just looking for however many cookies you're going to provide them. All right. That's the bank and the traditional lenders. And that's why a lot of people gravitate to them because they're easy. All right. Then you got your venture capitalists. Now, VCs, they're a different brand, right? Different folk out there. Um, they are much more hands-on. They typically look for a business that has a board arrangement. And if you are on that board as maybe the president or CEO, right? Interesting dialogue. They want to make sure that you have the right ability to lead that business and the experience to lead it. Otherwise, they might be looking for a board where you're just the president and then there's somebody above you, right? You're essentially working for the board. And they typically want to be on that board. They want a governing seat, a vote. And essentially they put themselves to where they're either your equal or they're your boss. And you're taking orders from that particular investor. Right. And that's typically how the VCs work. And maybe that's a good arrangement for you. Maybe you're open to that. Right. High risk, high growth. You're looking for somebody that can jump in and connect you in different ways, and that might be the right avenue. Just always remember they are much more hands-on. And when you take companies that have had investment from VCs versus banks, completely different experience. You just have to be prepared for it. Right? Angel investors, much more hands-on as well. Those are going to be your senior individuals that have experience in specific industries. They jump in because they have the money, as well as they find that they can lend their skill set network to support you, right? They take just as much of a kickback as the VCs as far as the risk reward, which is going to be higher, typically some type of share or profit within that business at the exit stage in most cases, right? But much more hands-on with an expectation to do so. Right, and then you've got your private capital sources, and private capital that could be, your uncle, right? It could be friends of the family. It could be crowdfunding. It could be all different types of capital, right? And that can go either way. It can be more hands-on. It could be more hands-off. It just depends on what's been crafted based around your opportunity. So just remember there's different expectations and relationships around these. You have to understand what's going to be right for you, right? What's going to allow for you to have the freedom to operate, the insight, the control. Remember, you're the driver in this conversation. And so which car do you want to jump into? Okay. All right. So look for experience. I can't say this enough. You don't really want to work with a banker that has zero understanding of your industry, right? And has no help or support and that can get spooked like a horse, right? Anytime the littlest news comes out, or let's say something doesn't show up correctly on those financial statements, right? You want somebody who's going to be able to lend information and insight and guidance. It's a rare opportunity for you to be able to get somebody of high caliber or skill to support you in this manner on an ongoing basis. So look for that experience, right? And then find a relationship that can support your growth. Now, when I say growth, I do mean business growth, right? Asset growth, like we were talking about, but I also mean personal growth. Again, you want to work with somebody that you can connect with, that you can enjoy, that can guide you and lead you. It's almost as much of a mentorship road as it is about financial support, right? So find that relationship you can connect and communicate easy with, but you find value and it can support your growth personally as well as the business. Now, if you've got a really good plan and you've got a really good business, then it would be no wonder that you might have many options. Okay. And that's what I hope for you. I hope for you all to have many options. But I want you to feel comfortable enough in your analysis, right? And understanding where you want to take this business and this whole bankable conversation. I want you to feel comfortable to say no. Right now, um, a lot of business owners in this recent climate with government loans almost being like candy, in a bowl, and they come in and they just grab handfuls and start eating it, right? Know when to say no, please. And no might mean I'm not certain that I know how to use this money to the best of our ability, or that it's just not the right time, or that it's not the right structure. You're not going to be able to spend the money in the way that would be required of you, right? Have the strength and the confidence to say no when you know it's not going to be of huge benefit to your business. Right, and finally, I like this because I think it's really important. Communicate, communicate, communicate. It doesn't matter what type of investor you have or that you're working with. All investors want to know how the company is performing. In fact, some of the best small businesses, what they do is they create a structure around communicating to current investors and future investors. They might post press releases, they might post their company financials, right, on their website, or send out communication in a manner that helps with some clarity on where they're going and what they're driving to and when they've reached those goals, right? Um, it helps with gaining confidence from existing and future investors. It helps when you're working with even clients, right? Um, how much of those investment funds are going to be returned? Does it look like the company's on the right path that they said they're going to be on, right? Maybe they need more funds. So is there an opportunity for those investors to jump in and support even more? Right? Financial statements, board meeting minutes, earning calls, right? Press releases, all of that gives you an opportunity to communicate with those future or current investors. Just remember that over communication is never a problem in this situation, right? Being forthright and over communicating, never a problem. But anytime you under communicate, you don't tell that investor about a new opportunity or a lost client, that always is a problem, right? That's always a problem. So consider how you communicate. Right, jumping into kind of like the end all here, right? I like to think of it that way. Financial ratios. So when we're trying to understand how are we doing in our business, right? Remember, we went through the whole journey. We understood the financial statements. We got a good glimpse at that. Everybody's on the same page. We understand what good debt and bad debt is, right? We understand like understanding good debt, bad debt, our investor options. Now I want you guys to really understand how an investor looks at a business to determine if it's in financial stability, if it can take on more debt, or if it's so far over its head that it's written on the wall that it should file for bankruptcy. Okay? So let's get started. There's a couple ratios. Now, when I say this, please don't roll your eyes. I promise I'll make this as easy to understand as possible, right? But these are just basic ways to compare your financial well-being that investors are looking at even before they talk to you. So please, the goal is for you to know about it. And so you've run these numbers, you understand what goes into these conversations before you get in front of investors or before you file for bankruptcy. Okay. All right. So times interest earned, we call that the tie, right? I like to say before you go into a meeting, you always want to make sure you got your tie straight, right? So it's a measure of a company's ability to pay their business debt, right? It's looking at your earnings before interest and taxes. We call that EBIT, all right, or EBT, right? Or even if you got a very simple financial statement, it might just be your net income on the bottom of that profit and loss or income statement, okay? And then you're just going to divide that by your interest expense. So if you've already got debt, you're paying interest on it, you're servicing the note, right? What's just the interest compared to that net profit or those earnings? The goal is that you at least got a 1-to-1, right? For every dollar of net income or EBIT that you've got that dollar of interest expense, and so you can cover it. The ideal would be to have more money, more cash flow than what you have in interest expense. Right, so these are simple things, right? Simple ways to measure how the business is doing. It just gives you an understanding of how many times that business can repay their current debts and really whether or not they are reinvesting in the business. Because if you have a really high tie number, like let's say 3, so for every dollar of interest expense, they're generating $3 in earnings or EBIT, that might be considered high, right? They might say, you know what? You're not investing enough money in the business. You're not growing the business. You're just keeping the money just sitting there, not being utilized. And so you're not taking advantage of the full potential. Why do you want my money? Right? Use your own money. So at the end of the day, it has to be a good blend. Okay, so that's the tie, right? Next is going to be the debt service coverage ratio. So for a debt service coverage ratio, you want to measure the company's ability to repay back their loans. Now, it sounds like tie, right? But tie was just the interest portion. That's just servicing the loans. The debt to service coverage ratio is paying not only the interest, but also the principal, right? The principal and interest payments. And that's a very easy comparison. You're taking your net income, right? So this would be EBIT, EBITDA, just net income, right? And then you're comparing that, you're dividing against the principal and interest payments to be made. All right, now remember, this is typically for a period of time. So if we were looking at a year's income, say last year, 2020, we're looking at last year's EBIT or net income from that profit and loss statement. And then we'd be looking at that same financial statement, right? We'd be looking at what was their principal and interest payments to their loans. So we would take what that was, multiply it by 12, because just like the income is on an annual basis, the principal and interest payments need to be on an annual basis. So we're looking at the ratios on an apple to apple level, right? And you'll divide it. And so the goal is for every dollar of debt that you have to repay, that the company is able to generate that net operating income or net income that's $1.25 or more, right? So not only are they paying their debt, but they've got a little bit of extra money coming in to help the business grow. All right, so you can find this information on the profit and loss statement, as well as what we call a debt schedule, which has your outstanding obligations for the business. Very, very simple. Right? Again, none of this is rocket science, but you do want to make sure you understand where you are in the conversations ahead of talking to those investors. It would be really embarrassing to walk in and ask for, say, $100,000 and not have the ability to repay back that amount, right? The investor would look at you sideways and probably discount you, right? So we don't want that to happen. All right, now let's talk about the quick ratio. So when we talk about the bankruptcy conversation, remember that's the insolvent or the debt leverage that we talked about. We don't ever be in a position where if we had to close up shop, close up our businesses, that we owed more money and liabilities than we had cash, right? So that's the simple equation. You're taking your current assets, cash, accounts receivable, inventory, current assets, divided by current liabilities. Who do you owe today? The goal is to at least have a 1-to-1, right? That means that you're break even. Now, if you had $2 in assets for every $1 in liabilities, right? Fabulous. That would be really good health. But if you had a less than one, right? Meaning that you have more current liabilities than assets, that's where you have to put the pause button. Right? You have to take a good, long, hard look at your operations to determine the viability of the business. Right? Typically, that current ratio, as well as what we call the quick ratio, it's a version of it. That when that gets really low and the cash flow is really cramped, you don't know when you'll be able to generate more sales, leads, revenue. That's when we start to get serious, and if the other ratios, the tie ratio and the debt service coverage ratio are poor as well, you're not at a 1-to-1 ratio, you're below that, that's when we start to worry and we start to get to a point of calling up the bankruptcy attorney, right? Unless you've got a clear plan on how you're going to turn it all around. You've got a lot of leveraged assets, meaning that there's not a way to get out of the conversation intact, meaning that they're going to want to sell off some collateral and leave you with very little. That's when you know that it's time to pick up that phone and make some hard decisions. All right, so the quick ratio, as I had mentioned, the current ratio is just all current assets against all current liabilities. Quick ratio takes it a little bit more seriously. They're basically looking just at the cash and any cash that you can create in a very quick amount of time. So inventory would be taken out, right? Any raw goods would be taken out. This is something that if you literally shut the door within a week, right? How much money would you be able to have and compare that against the current liabilities that are outstanding? Right? You can get all of this from the balance sheet and just make those adjustments and what you think are cold, hard cash, current assets, right? And make sure that you're looking at that. That's a much more realistic understanding of the health of that business. All right, and then I'm going to end on return on assets. So what is return on assets? It's just like ROI, except instead of looking at the return on investment, right, it's looking at the return on assets. And a lot of small businesses, they aren't looking at a ROI as much as just understanding how they're taking their existing assets and reinvesting cash to grow them. Right? This is a much better way of understanding if you're generating value not only to yourself as a business owner, but to investors. So you're going to look at this just like the other ratios on a periodic measure. You would look at maybe from our examples 2014 to 15 to 16 to 17, right? And if your ROA was getting bigger, right, you're trending in the right way, you're providing more value as time goes on. So the operations of the business is sound and you're actually growing. That's the way you look at an ROA. You don't look at it and say, oh, my ROA is 2, I must be okay. Right? That doesn't help you. It's a measure over time in comparison with your own performance. Okay? All right, so it's super easy to figure out. You're just taking your net income, right? Remember, profit and loss, balance sheet, net income, and you're dividing it by your total assets from the balance sheet. And as long as you're generating more net income to total assets, right, we're growing, we know that we're providing additional value to those investors. Very, very easy. Just know that it's a better way than a return on an investment for a small business. All right, and so I like to give you guys just kind of like a view of how this all looks when you put it all side by side. Financial ratios is something that you can do on your own. You don't need to run into an investor or a lender to do it. I recommend that you keep up with your own financial health of your business, right? It's in your control, it's in your power. And so here in the investment world, we look at liquidity, right? The current asset, the quick ratio, or current ratio, quick ratio, working capital, how much cash you have available, right? And if you have inventory, right, how much inventory days, accounts payable, like how quickly do you pay your vendors or suppliers, right? And then we go into profitability ratios, right? So that would be like your net profit, your gross profit margin, your EBIT, EBITDA, right? Operating profit margin. And again, these are just numbers that you're comparing, and then you're just looking over time how the company has performed. All right, and then of course we go into solvency and then even growth ratios. Just know that anybody can do this, right? You can get a template, you can pull it online, you might even be able to find these ratios in your financial statement reporting software, right? Or if you have a POS system that helps you collect data, you might be able to find ratio analysis in there that would be relevant to your industry, right? Everybody has the ability to look at this and to compare their performance and to know their numbers ahead of having any major discussion with investors or attorneys. All right, so getting towards the end, details to remember, right? Please, please, please review your financial statements. And if you're not used to doing this, then just take out those three that we mentioned, the profit and loss statement or income statement. Remember the balance sheet, my favorite, right? And then that cash flow statement. Pull them out, take a look at them, do the side-by-side review. All right, know your reasons behind borrowing new money, right? If you're trying to borrow new money, know whether it's plugging a hole or it's actually helping with the growth, right? Understand which investor relationship is needed for your project. I gave you a good overview, right? Understand the give and take conversations. What are you willing to give, right? What do you need to take? Know that from both ends. And then I like to say interview before you've been interviewed. So if you're looking at potential investors, give them a call. Find out where they are, right? Ask them what they're looking for. Where are they on these ratios? Right? And get a good understanding of whether or not you're a good fit. Run your own ratios. You're the driver, right? Money is a tool. You're looking at how to use it in the best possible way to take your vision far. So make sure that you are in control and know where those numbers are saying about you and the story you're saying. And remember, review your give and takes. What are your expectations? And mitigate those risks, right? If you mitigate the risk, make it more advantageous for that investor and they'll reward you with a smaller cost, right? And then always feel comfortable asking for support when needed. Your SBDC advisors are there 5 days a week, probably more than that, right? And they're there to help you. So if you have a need, reach out to them. They can support you. Now, my name is Rebecca Schultz. I'm the founder executive loan consultant for Centerlock. It's a pleasure being able to be with you today and be your guide in this journey. All right, if you have questions about the presentation, I'm happy to help you. All right, just reach out to your team and they will go ahead and get in touch with me, or you can reach out through my email. Thank you. All right, I think that just opens up the floor to any questions that came up.
Yeah, couple of questions or comments. Let's see. Okay, what happened to the guy that brought you the balance sheet?
Yeah, okay, so in that particular situation, he had no idea that he was saying all those things about his business and he had to take a step back. I honestly hadn't talked to him after we had that conversation. I know he was set to try to grow his business,
Uh-huh.
but I never heard back from him. I just spooked him.
Yeah, okay, I can imagine that. If you have any questions, please go ahead and unmute yourself and ask Rebecca. She's wonderful. She'll be happy to answer whatever. And in the meantime, Rebecca, as always, it's wonderful to have you. Thank you so much for joining us. Roger, did you have any questions?
Yeah, hey, because you always know I do, right?
Yeah.
How you doing, Rebecca?
Good, how are you?
Good, thanks. Um, you know, what I've seen is just such a influx of the idle, and unfortunately, sometimes these businesses are taking the idle, and I don't feel like they're understanding, the responsibility that comes with that and the payback, because it's sometimes more money than they've ever had at one particular time being shoved into their bank account. And I'm just curious how you might be counseling, businesses when it comes to that, because I've seen it a couple of times where now that they've opened it up to get more money, the customer coming in and saying, I've already used up all the money the first time, and I kind of gasp at that. I'm like, when these businesses are smaller in nature. So I was just curious about that.
Yeah, so I had a really good example of that, Roger, yesterday. So I'll tell you the story, okay? I'll tell you what I told him. But I think it fits exactly what you've just explained. So it was a small business, sole proprietor. They got $500,000 through the idle in two different draws. That's more money than this couple has ever seen at one point in time, right? Their conversation to me was that they were going to open three different businesses with that money. All right. And they wanted to see if they could go back and get more now that the amount went from 500,000 to 2 million. They thought they could go and get more money. And their whole premise to me is that they're good custodians of the money that they've received, and they have great credit, and they're going to do well with this money. Right, and they miss the point of exactly what you said, that there is a difference on how these disaster funds can be used in a business as opposed to other outside investment money, right? The whole premise in getting disaster assistance is that it's supporting that business with survival, not growth. Right, and so they came into it saying there's three business ideas we want to take this money and invest it in. And immediately I had to pull back those reins of expectation and say that's not going to happen. You can't do that. Right, this money is only available for that one operating entity to pay their obligations, to pay their bills, to hire, right? And that's essentially it. And to go through $500,000, it will take you longer than 3 years based on the information that I was seeing. So just understand, like disaster assistance, it's not for growth. You can't take that money and go start up another business or um, unless you have a conversation of replacing equipment, right? Replacing equipment for survival. Just always follow the survival conversation. Growth money is different. Growth money is a completely different conversation. And anytime you are making decisions, I want you to always make decisions from a standpoint of if you were audited, right? And you had to show the government or the IRS what you did with their dollars, that it should be a very quick and easy conversation. You have that money in a specific account. You can see your payroll coming from that money or those approved expenses. And that any growth money, right? Like let's say you are going to go ahead and do something on growth. That's coming from a completely separate account. Okay. Separate account, separate conversation. And I'm going to be an advocate of being able to project out what you think is going to happen, right? Do those, we call it the rolling 120, where you're looking at least a quarter out from where you are today in making those decisions. And so as you're trying to guide and be a good custodian of the government money that's been provided, right? Use that. You're always able to see how the disaster funding support is going to benefit the business, but then at the same time, how are you growing beyond that money, right? You don't want the quick and easy money. It's like the junk food, right? How is your business doing in growth and sustaining and getting back on track to be able to continue operating? Now, the other side of what you mentioned, Roger, is that it is kind of scary. These people are about to start seeing the repayments hit at the beginning of next year. We're only a few months away, and they are fat and happy. Right? They haven't had to think too much, right? They're kind of relaxed. The turkey's going to be done, right? Like pretty soon. We got to make sure that you're able to repay those debts, because if you can't get the cash flow in a point where not only, because you're not going to get the disaster assistance money, right? Like that ends at the end of this year, that ends. If you don't, if you're not putting it aside to grow the company, there comes that tight spot where you're not going to have potentially the cash flow to continue. And that conversation's devastating if the business hasn't really put the effort in to show how they're going to create the return and repay back that government money. Because government debt, you never want to ever default against government debt. All kinds of bad things can happen.
Yeah, thank you, Rebecca. And you know, a lot of the people that have come in don't particularly understand the difference between, the personal guarantee and the not personal guarantee of that debt as well. So, and I know that, you just went through a great synopsis of the lending and how one goes about, getting that lending. And the idle funds were the exact opposite of that, right? It was, if you can fog a mirror, right, then we'll give you the money, so to speak. I hate to use those terms, but it was really easy to get those funds, and it's just a little concerning. That's all.
It is. I agree with you. And I hope anybody who is on the call that has concerns after talking about or just hearing us, right, that you stop and you go and try to figure these little pieces out, right? Line things up, line up your dominoes before a potential audit. Because what I'm seeing on my end is there's going to be a lot of audits, and I'm just telling people to go ahead and turn themselves in now. I know that sounds terrible, but I mean, I have seen some eye-raising scenarios, and the sad part is that the business owners didn't realize what they were doing at the time. They didn't realize how many lines they were crossing, and how, from an outsider, their actions looked like they were taking advantage of the government debt, right? And they were misusing it, and that they could see penalties like prison time or horrible fines. Like when we, honestly dragged out the way it would be reviewed by an outsider, they were floored. They had no idea that they had created such a nightmare from the outside. And so if you are concerned, right, good. Get on the phone, set up that appointment, start looking at that. And in some cases, like I said, you essentially roll up your hand and communicate with SBA before they find you, and essentially say, this is what I did, this is how I'm correcting it, because you do have the option to have an open dialogue with the government, and then it shows a different character when you're in that situation, right? Like I borrowed too much money. This is what I'm going to do. This is how I'm going to overcome it. It shows the character that you do recognize and that you're trying to correct or amend and get back into, the good graces of the government. I don't know what to say. It's some scary stuff.
Mhm. It certainly is. And it's, I have talked to some folks that didn't quite follow the guidelines on how to use the funding that they received. So I'm kind of concerned about some of that. Um, do you have a comment? I would love to hear your opinion. How will this shake out? How do you think this will shake out as far as when the payments start and somebody finds out that somebody bought a Ferrari or something like that.
Not good. So I've
No.
been actually monitoring that
No.
primarily through Moody Analytics and Experian Small Business Credit. So I have access to Experian as a tool, and they've been doing a monthly review and looking at repayment trends and going back and connecting data to the pandemic and unemployment rates. And they've done a fantastic job really trying to connect these pieces for an understanding where the economy is going to be headed in the near future. And so everybody is saying that I'm looking at that once the new year starts and the repayment to the government debt starts, that they're going to start to see the bankruptcies kind of hit the ceiling. Like it's all going to start to happen. And then at the time that bankruptcy proceedings start heating up, and that's going to go for a couple years, is what I'm hearing,
Oh.
right? There's going to be that individual review at those for those individuals of how they use those funds. You know, from me to anybody listening, you don't wait for the government to see or ask for how you've used those funds because it goes beyond that, right? So if you're working with a bank and you've got a line of credit, if you're working with any lender and you've got a line of credit and they're asking for your tax returns, they're asking these same questions. And what maybe you don't understand is those banks, I'm not saying that, your sweet little banker that you have a good relationship is going to turn you in, but I will say that they make it very advantageous for people to be turned in and receive bonuses and rewards. Okay, like this is no joke. Like anybody who's looking at your numbers and
Mhm.
connecting the story has the ability to blow a whistle. And like like you said, Paula, it is public information for those individuals that have received dollars, right? That information's out there. So if you don't think that this is going to come around or that you'll be able to sweep it under the rug, I don't think that that's an option here. I think for somebody who wants to continue operating their business and continue finding support, right, then you really have to walk a very tight line. And then if
Mhm.
there's any kind of scribbles outside of that line, go ahead and clean those up now sooner rather than later because that could be to your disadvantage if
Mhm.
they were lining you up for a character.
Well, it goes back to what you said earlier. Communicate, communicate, communicate. If
Boom.
there's a problem, get in front of it.
Exactly. And be honest and show that you're doing your best and you'll find so much more favor on that side than trying to hide it and hope that nobody finds it.
Yeah. Yeah. Well, again, valuable information from Rebecca. I just want to make everyone aware that you'll be receiving a survey in your email. Please give us your feedback. We always love to hear more about what topics you want to hear about and how best we can improve our program. You see on the screen now our upcoming webinars. Uh, Laura Kibbe is back talking about continuing her series in how to create a presentation. Then we bring Eric Spellman back. He's always fun. How to rank well on Google. Good topic. Marcia Hudson comes back. How to attract online shoppers during the holiday season. It's coming up quickly, quickly. We have a new presenter, Melissa Forziat, how to win at social media. Another expert on social media. Excellent, excellent presentations. Lorna's back, slides and other visuals, and Melissa is back to help boost holiday sales. You can access all of these webinars to register on our website, sbdc.nctc.edu, or you can actually use the QR code in the upper right-hand corner of our slide. There you can register for the webinars, you can get contact information, you can schedule an appointment, use the resources that we already have out there available to you, like the new tool called Size Up, where you can get industry information, local industry information, just to compare your business to other similar businesses in the area. I would love to thank our benefactors, the funding that we receive from the Small Business Administration, the state of Texas, North Texas SBDC Regional Office, and North Central Texas College enable us to bring our services to you at no cost. Thank you all for joining us today. Be sure and join us tomorrow, and we're going to go ahead and end today's webinar. Have a great one.
Thank you.